Well, good morning, Chris. How are you?
I'm great, thank you. I'm great.
Good stuff.
Really interested to get into this viability in a much greater detail in ProVal.
Yeah, this is a little bit more challenging, a lot more detail that we've done. But what I want to do for this, I think, is just have a little recap of what we talked about last week in Landval, and just emphasise kind of on one part. Obviously, introduce myself. My name's Andrew Markham. I think everybody is on here now. Is that right, Chris? Are we happy to?
Yeah, we're recording it, Andrew, so we don't
Yeah.
want to keep people waiting.
Okay.
We've got I'd say 70 to 80% of people.
Okay, fantastic. Hopefully, this is going to be more challenging for me because it's going to be kind of different screens. So I'm going to kind of stop some things and then go to different screens to kind of emphasize what I've tried to do on here. So last week we talked about land val and the effect of sales prices. So I've kind of taken that example and put it into ProVal and looked at the different kind of mix optimization that we perhaps could think about and do in ProVal. Okay, obviously in ProVal a lot more detail. So kind of got some different scenarios. Obviously, if people don't know me, my name is Andrew Markham. I work obviously at SDS. I have done for a number of years, about 11 years now. My background is development. Used to be a land buyer, so I can understand viability. That's my kind of bag. That's what I do. I help a lot of clients. We've set up over the last couple of years a development consultancy side, so we can actually do a lot of appraisals for clients, give that kind of audit trail view, just that kind of critical friend as such, I suppose.
Yeah.
And I've been working with lots of local authorities recently, so kind of actually getting into the detail and actually do appraisals and advising on some fairly large schemes.
Yeah.
Yeah.
And my name's Christopher. For a while now, I've wanted to unlock the knowledge that we have internally for myself and for our clients. So I've been able to do this recently. And, I deal with new business. I look after current accounts as well. So what we really want to do is just try and give you as much as we possibly can at the moment. Just a little bit of housekeeping before we start. If you want to shift your view to show active speakers, then you'll probably see a lot more of the screen real estate. We do have a Slido presentation or a Slido code, which will pop up a little bit later. If you're having any technical problems or have any questions or even want to ask about anything as we do this, you can message me. I'm coming up as Rob Shelton. I'm not Rob Shelton. I'm using his Zoom account. But yeah, message Rob Shelton and you'll be talking to me. So without further ado, let's do a quick recap. This is a follow-on from last week where we looked at sales value, and I won't get into it, but Andrew's going to do a quick recap and then we're going to dive even deeper using ProVal.
Okay, brilliant, excellent. Well, I'm going to stop my video and then go straight into the kind of presentation, and I'm directed by Chris. Hopefully you can kind of see it on screen. So obviously last week we talked about the sales effect and really kind of we talked about the gearing effect. So a small changes in sales value has a disproportionate effect on value, okay, on either the gross margin or land val. So what I was showing people last week was this part, okay. So here we have quite now obviously a lot of RPs, local authorities, housing associations, ALMOs, etc., a lot more exposed to the sales value. And the reason why we're talking about this is that obviously we're heading into uncertain times. Sales are reporting a 5 to 10% change in sales value, and as Chris alluded to earlier on, a kind of a quick, sharp drop in sales values, then hopefully quite a quick recovery. But we don't know how long that recovery will be. Okay, so the question we need to look at when we're looking at viability is modeling a number of different scenarios. So let's first, before we get into the detail of ProVal, is look at the first part on land value. So if you're out there or you purchased well, if you're about to purchase or going through contractual legal information to obviously to purchase a property, then these are the things that you need to kind of be look at a site. Sorry. So sales values 250,000. Here we have our build cost of 125. We have our gross margin. So here we're putting in a gross margin of say 20%. That's generally what the private sector would do. And then we have our bottom line of 75,000. Now, if we put a change in sales value, what happens to this bottom line? So you can see here an increase would have a 13% increase in our land value, but obviously a decrease would have a 13% minus value on our land. So this is something that we need to kind of think about and review when we're actually active in the sector. If we flip this and look at the profit part and gross margin. Now, some people say to me, well, what do you mean by gross margin? And gross margin is not always about profit. It's really the risk element of getting the sales price wrong. Okay, so here you can see the profit scenario. So we've got the bottom line here is our gross margin, sales value of 250,000. We've still got the same kind of build costs and our professional fees, but our land is fixed. So we've purchased our land for X. We've put that into the kind of model, and you can see what happens to our gross margin. So you can see here we've got 50,000. Then we apply our kind of sensitivity testing and say, okay, a 5% decrease in sales value has a whopping kind of 25% change in our gross margin. So this is what we in the sector in development we're concerned about, is understanding what is going to be the sales value. And if we've got units coming to the market now or in the next kind of 3 to 6 months, this is what we need to kind of be thinking about. Understand that, Chris?
Yeah, absolutely. That's only 5%. I mean, 10% is.
Yeah, it's going to be quite short, sharp. But remember, if everyone hasn't seen the kind of Savills kind of podcast webinar that they've done, it's really worth having a look at that on their website, because it does, though, they do say that their forecast for the 5 years is still keeping the same. So they are still saying that in 5 years, they're still sticking to their overall target of 15% increase in sales values. So
they justify that by saying that there's a market correction due because obviously Brexit, since the referendum in 2016, there's been really not a lot of long-term investment in England. So we were all expecting, all the financial markets were expecting a fairly big correction, and obviously that was scuppered by COVID. So it's that correction that they're attributing that 5-year sort of aim to. But again, I don't know, a U-shaped recovery. To me, that doesn't, I don't see the sense in that. But
well, I think that's what they're predicting. Savills got the data. We'll hopefully that will ride out, and hopefully this is a short, sharp shock to the system. Once we get back to kind of normality, then prices will recover quickly, and that's what they're forecasting. So hopefully you can see a spreadsheet that I've got here. Can you see that, Chris?
Yes, absolutely.
Okay, great. So what I've done here is following on from what we discussed last week, is reviewing the sales price here and then showing you a kind of 5% decrease to the new values. And what I wanted to highlight just quickly, recap, is that the different options that we had in here, and you can see the kind of effect that was having on this. So this is our scheme. We've got kind of a 60%, we've got a kind of a 40% that kind of affordable on 30% and a 40% and a 60%. These are the kind of different options that I had here. And you can see the gross margin that was being achieved by the mix that I had in land val to offer our land position. So I've actually fixed the land value and said we are paying 1.6 million for this scheme that's giving us a 22% gross margin. and that was the value that we had. Now we apply this 5%, and you can see the difference that was coming on. So this now drops from 22 to 16. And then further on, as you alluded to earlier on, a 10% drop will then give a change of 31%. Now
Maybe
you might
could
say,
just zoom that in a little, Andrew, just the view just a little closer. We've got a lot of empty space at the moment.
that would be a challenge. How do I do that?
And
Okay,
then,
yeah. Okay, is that better?
okay. Yes, that's better. Thank you.
Okay, great. So you can see here that a 5% change in sales value has this value and drops to 16, and the 10% drops to this. And the various different options. Why am I showing these different options? Mainly because private sector will try and get to a 30% position. Mainly in housing associations, we're trying to look a little bit better or more on the affordable. So I've got a 40% position and a 60% position. You can see here the effect that would have on this scheme. So lots of the private sector will be renegotiating their Section 106 as much as possible to actually mitigate this loss. So you can see here that we've got an option of 40% affordable here. That comes into the numbers. We've got a land value, 18%. Then we have a look at the 5% decrease, and we can see what's happening to the figures. So we can see we're dropping away here to 20%, and obviously a 10% would have a change of 40%. So that's quite dramatic. So this is why, you know, we would need to really look at remodeling, revaluing as much as possible. And as I said before, Chris, that most people would be, you know, looking at sales values on a weekly basis, not just monthly or not just quarterly or 3 monthly as valuers would do, you know. So this will be in touch with what's happening. So if we said this is going to be a short, sharp shock to the system, then housing associations and local authorities might be more resilient to this, because we're looking at over the long term. Can you see? Obviously, this is new to me, kind of Zoom, is it? Can you see?
Yeah, we can see
Provel?
Provel. That's fine. Yeah.
Okay, great, excellent. Okay, so what I've done here is taken that scenario in Landval and put it into these options. This, and remember, this is one scheme that I've done, and you can see the number of options that I have modelled into here.
Did you just slide that straight into Provel from Landval?
No, I had to replug it, obviously, because there's a lot more information in Proval, and we're kind of modelling something slightly different here, aren't we? So my original here, sorry if I open it, because my system did crash. So here we go. Right, so I've my original position. Right, okay. Yeah. So this is my original scheme that I looked in at in Landval. And if I open the kind of, I don't want to go into too much detail of the structure, but obviously this is what we're looking at here, a 40% compliant scheme. So that's my kind of middle road. And I've got my affordable units, I've got my shared owning units, and I've got my outright sale. So here is returning, obviously, when we look at an investment model, we're looking at NPV, net present value, over a period of time. Obviously, there's a number of settings in here that will be different to different organizations. But I've taken the kind of mean, the average of what most people would be looking about. So these units, and we've got the sales value in here. So we can see what would happen if we then ran the scenario. I'm looking over this over 35 years. I've got an interest rate of 5%, a discount rate of 5%, so we can see the kind of results. And you can see that this is actually paying for itself in 29 years and giving us a positive NPV. So if we run the kind of model forward, and then we say, okay, what would happen if we have a 5% decrease on this scenario? You can see that we get to a negative position. Okay, so now the outright sale part is start having an effect of the cross subsidizing of what we're doing into this scheme. And if I then kind of run it again to a 10%, sorry, just run this. Okay. And you can see the effect of the MPV dropping quite dramatically away.
Can you zoom in on that, or I don't think I can see that exactly.
Okay.
Actually, what is that figure? Is that minus 1 million? Oh, that
Yeah.
zoom out just a couple notches in, and
Yep.
it looks like that should be fine.
Yeah. So you can see our basic.
One more notch, please. One more notch.
Okay. All right.
All right. It's still a lot of.
Oh.
Oh no, we've just gone back.
Yeah.
Is there a shortcut to zoom in?
Yeah.
That should be the next update.
So here's our units that we are modeling, and I've modeled a 10% drop. You can see our MPV drops away. Okay, so that's fine. So this is what I was replicating in LandVal into ProVal. Okay, when we're looking at the effect of the reduction of the sales values happening in here. Now, you know, we're doing the same thing. We are kind of looking at kind of rents. We're looking at value. We've put in our costs a gross margin. So we are saying that we are going to force a value in here to mitigate our cushion of getting the sales value wrong. So in here, and most clients would use kind of anywhere between kind of 8 and 15% on this to actually see the effect on that. Okay. So if I go back to my spreadsheet, and hopefully you can see that. And if I go to my kind of affordable view, and this is the same values, and you can see obviously the drop in the sales values happening in here, and the scheme that I was looking at here, or the mix that I was looking at here, is a 40% affordable, 60% of sale. These are the units and the mix, and you can then see the MPV, and you can see this effect dropping away. So you can see the MPV on a normal scheme or a normal position is making a positive contribution to the organization, and then the decrease, spelled wrong, in sales values in there to you can see what's happening, and it's dropping away by kind of by that 5 and 10%. Okay.
Oh.
Yeah. So
it's a very shallow, it's a very delicate thing, this, isn't it? We've gone from 300 up to minus 1 million at minus 10%. That's all it took.
Yeah, exactly. So you can see the kind of effect on that. So what can we do on this? So what I kind of attempted to do was have a look at different scenarios in this, and I'm just kind of waiting for this to close. And so remember, you know, obviously clients, most of the people who are on this have probably got ProVal, and they can kind of play with the numbers and do different scenarios themselves. I think it's important to remember that it's to get the mix or the unit types in there that you may want to model. So here I've put rent to home buy, and I've got private rent. So here I've put some unit types in on those different tenure types and the different kind of settings that would correspond to that. And obviously our assumptions would be slightly different, because obviously a private rent is very different to a normal affordable rent. So if I open the private rent option that I did here, and I close this one. So now I'm looking at this slightly different. Okay, so here on my view, that I've kind of changed the mix slightly. We still got our 50 units. Yeah.
Yep.
And we're changing these to a private rent. Now, remember, private rent is a different product. So we have to kind of look at our assumptions and make sure that they're correct for that different product. So here, I've got our same position of MPV, but when we go back down to our kind of allowances, you can see what I've done differently as such. You might obviously increase your management costs, but probably generally not. I've got our maintenance. Your maintenance might be higher because you are kind of, you might want to increase those to cover that. But the main difference that you would have is the voids and bad debts. Now, obviously, private rent is exposed to the market. The market generally is between 8 and 10% on voids and bad debts, whereas the affordable units are kind of a lot lower, say 3%. So here is where we can kind of put in a unit type in ProVal to correspond to what you're looking at. And then I've just quickly flipped the different tenure types and showing the impact of what we could do here. And then I've added the actual different impacts on the sales value. Obviously, having lower sales units to actually sell has a lesser impact for the scheme. So you can see here on this one, which is a 10% decrease and a 5%. Sorry, just gonna, I have to kind of load them up separately, Chris, to
No problem.
show you this. I'm just going to just take that out because that's really frustrating. Right. Okay, so here, what I'm showing you here now, hopefully, you can see that we have this is the standard scheme that we changed because we put private rent in, and you can see here we're making a small surplus. So we're still making a surplus on this, but we've got less risk because we've reduced the outright sale units. And then I can apply our Savills thinking of what's happening. Okay, so now you can see that we have a lesser risk value because we have obviously reduced our sales units. So we still have obviously a negative position. I've done these appraisals without any subsidy. So, we can kind of obviously offset this by subsidy, either coming internally or coming from an outside source. So here, I've done that and then looked at the position on our 10% position. So you can see the effect of that. Hopefully, there is a lot less of an impact than the before. So here is the position that we had of the same kind of unit here, of the same mix, but changing these to PRS or private rent, and you can see the effect of this. We have a lower starting position, but then the effect of the 5% and 10% drop in sales value has a lesser impact on our bottom line than obviously having a full 60% kind of sales value.
Right.
Okay, so that's there on that. So the other kind of the position that I wanted to kind of just kind of touch base and show you, and if I close these, sorry for kind of opening and closing things here, which it makes it a little bit kind of slower, but is the impact of what if we change this to a rent to home buy. Now, obviously, if Savills are correct in their saying, and things are going to have a quick, short, sharp drop and then a kind of quick bounce back, then perhaps we should look at, hang on, sorry, rent to home buy, let's go open that. We should be looking at different tenure and how we're going to model that in ProVal. So here I've got the original that I had. Let's open this. So slightly more kind of tricky to obviously to model, but no doubt that you need to kind of sit around the table with your teams and can discuss this in a bit more detail and the settings that you're going to be using. So, right, we got that one open, but my original here, and I can hopefully go to full screen and you can see that. So we got the same kind of scheme information. So we've got 10 units of each of these, but instead of kind of obviously doing PRS, I've changed these to rent to home buy. And this is all a function that clients can do within ProVal. So you can go to the administration part, you can go to product types, and you can then set up your own product type in here. Don't change any of the kind of headings on here, just add a new product type, and then you can set the parameters and obviously even the color of what you're doing. So structurally, you can change it to how you wish. How I've done the rent to home buy is I've looked at obviously the values, we've kept the values at the same, and then we're just saying to this product that I'm renting it either at intermediate or a full market rent for a period of time. And that is all defined by you. So you can say here that this is still having the MPV discount period over 30 years, or should be 35 years altogether. And we can then set the sales value. So we can say in here, when are we going to be selling this? So it's obviously like a shared ownership unit, but I'm not selling any value at outset. I'm then just going down to selling remaining equity in a given year. So here I've put in 3 years. So in year 3, we're going to sell this unit. We're going to rent it for a period of time to get over, obviously, the impact of what's happening now, and then kind of sell it at a given period.
And I think this is what a lot of people are looking at the moment, Andrew.
Absolutely, definitely. I mean, the things that you need to consider is what is going to be your management costs, what's going to be your maintenance costs. It may be higher. You know, look, your products are going to be different. You know, it's quite simple in a kind of a spreadsheet way of just flipping this to a different tenure and trying to make this kind of work in the short term. But obviously, if you're on the ground building it for outright sale, it's a different product to rent to home buy. You know, so we need to kind of quickly reestablish what is the detail that's going into that unit, and can we change it to obviously rent it for a period of time. They are different products, but in the short term we could flip it. Remember, not forgetting that obviously our voids and bad debts and all these positions can be changed. So we're renting this, and we've got our maintenance costs, we've got our management costs over a period. So we've got this 1 to 3 that we are looking after this, and then we've got to look at our voids and bad debts. And I've put in here 10%. You know, most private rented units or intermediate rented is between 8 and 10%. So this may go up, obviously, because of people losing their jobs or uncertainty about their job, which will come. You know, unemployment probably will increase kind of later on in this year after we get over the initial period. So that would be a concern. We're only renting this for a short period of time. So, you know, we may not look at any major repairs as such, but there may be a cost that you need to put in here to obviously refurbish it, repaint it, to then sell it on the open market.
Okay. So am I right in saying that, so I thought rent to home buy would have been sold to the tenants. Can you would you have to move the tenants to sell it? Is that something you have to do contractually?
Well, absolutely. I mean, ideally, it would be nice to kind of sell it to the kind of the person who's buying it, or do a proportion of that. Yes, there's obviously a number of different models that you could do that. I know that kind of Crest Nicholson has signed with Halo to say they're doing a kind of shared ownership position, so they can kind of rent it for a period and then start buying kind of shares of that. So yes, you could do that. And here you can see that I've kind of modeled this for rent position over that 3-year period. So again, in ProVal, you can define the period of rent, and then in year 3, at the end of that year, we're selling it. So you can see, if I go to the kind of the long-term cash flow here, you can then kind of see the impact of that sales value coming in at the year that you specified. So if I know there's a lot of numbers on screen, but you can see we've got some shared ownership values coming in here, but then you can see the impact of that sales value coming in. So what we're kind of looking at is obviously a positive kind of cash flow on a year-by-year basis. Obviously, the first year we've got a bit of a loss here, and then we kind of have the impact of that, and you can see it kind of increasing as we go forward. Okay, so you know, I've obviously modeled this again by having the kind of options of a kind of a standard position. Sorry, I was in the kind of 5% decrease. So here is our kind of our standard one. Then we apply the kind of the 5% decrease, and then we have the 10% decrease as well. So
we got a positive NPV there on the, even with a 10% decrease.
That's right. That's right.
Sales value.
Yes, I kind of had a different position on these, so if I kind of update it, right, that's fine.
So how did you do that?
Well, because what I've been trying to show is the impact of changing this to a different tenure, and kind of setting that in here and showing you the results. So if I kind of go back to my kind of spreadsheet here, you can see that our 10%, our kind of changing it to rent to home buy to affordable on our 40%, 40% and 20%, you can see that it has a positive impact in the short term. And then obviously we're selling it in 3 years. So we come back into it. So this would be our kind of preferred position, not to going to probably do private rent, but obviously to change it to rent to home buy. And you can see the impact of that kind of 5% less so and 10% of the sales value dropping away on the 10 sales units. So we've got a nice mix on the scheme that we're doing. And then we're kind of putting in that 5% or 10% risk factor that Savills are reporting, and it has a lesser effect on the appraisal. You know, obviously there's lots of things in the appraisal that we could probably kind of review and look at to just see what the trend is, what's happening on these different product types that we're offering. So here we can kind of go to the kind of the results of this scheme, and we can then, you know, quite often kind of direct people to this position, and it's nice to kind of see the detail and say, okay, right, okay, here's the scheme. We've got the various different products in here, but you can see the actual impact of the different MPV positions of those products. So clearly here, our outright sale units are obviously making a surplus, but our kind of rent to home buy are kind of making a better position because we're renting it in the short term and we're not having the impact of the sales value being dropped, and then you can see you're affordable. So this scheme looks quite nice. Now you can open this section and you can then, you know, play around with the different kind of settings. If you think that obviously, you know, these private rent ones are going to be, rent to home buy, going to be more risky, we can change the discount rate, and that would impact on what we're doing. So you might say that these are going to be 6% because they're a little bit more riskier. So you can then see instantly the impact of that would have on your results. So you can see we can now kind of reduce our MPV positions on those two products. So in ProVal, we can break things down and to see the impact of that. So what's, you know, often I'm kind of asked is saying, why do we have LandVal and why do we have ProVal? Well, LandVal is giving you a kind of a quick assessment, the back of the fag packet we used to say in development, of the view of a scheme to get a residual land value or a profit position. In ProVal, obviously we need to do a lot of kind of more detailed analysis of the different products, but if you set them up in your default position, that then helps you greatly to kind of model them quickly in here. But we do have a land position that we will kind of drive out the residual land value. The first thing we will show you on this is the gross development value, which is the net rent. So the net rent of this scheme or unit over a period of time is displayed here. Okay, so and then we can add in, we don't take the actual fees and interest that are displayed in our total scheme cost. We ask you then to say, okay, what is that, is that what you want? Or are you going to say, okay, it's an industry standard kind of position, say 15%. We were going to take our kind of our gross margin of the different products that we might have, and then you can see what we're offering here. So you can then see a residual land value. We do have the optimizing position on here per acre, so you can see what is your plotting density. So you can put in here that this unit as a smaller unit, a 60 square meters, has a plotting density of 16. Now 16 is saying you can get 16 of these units on 1 acre, and obviously as you go bigger, you then get less. So we can give you an optimizing value per acre. So you can go in here 16, you can go, and this is 14, and this is our big unit, and this will go 10, and we can then give you a value per acre. So ProVal does give you a residual land value. Yeah. It doesn't do the kind of you can force in a value and then work back to a gross margin. This is being taken from the net rent. So we take the net rent and we can drive that up in here, and then we can then do your kind of fees and interest, any profit margin you're looking for, and then bring that forward. And obviously this one here would be another 20% because we're selling this in the future. So we can then bring that down to a value. And you know, there's a number of ways of kind of doing an appraisal. I mean, you could, you know, put all the information in as best you can and the best knowledge you have, and then you can leave out the land purchase. You know, so the land purchase now, everything in this appraisal is being detailed. It's in there, and we're showing you a positive MPV. So what you could often do here is say this is the maximum value you could offer, but it's not precise because MPV is not quite precise. It's obviously affected by interest and timings. So you could say that if I put in here 2.7 million that we're offering for this site, then generally you've got a minus MPV position. So you can see the effect of that, Chris?
Yeah, I mean, yeah, absolutely. So, you know, it does take, you know, a bit of obviously time to remodel different schemes, but I think it's time well spent. What we're doing now, the impact, you can see that I've got a number of different options here for one scheme. This is one scheme called Markham Heights. I've got a PRS option,
I've got a rent to buy option, and I've got the original. And the original was the original that I did in Landval. And then I put it in here and showing the impact of this 5% and 10% drop, and then saying, okay, that's our position. What can we do? So we can then move this into a PRS, private rented, model, or a rent to home buy. And once you've got the information in the original, it's fairly reasonably quick to kind of copy that original scheme. You can then duplicate it. Then you can add in your different options in here, and then model different things. And remember that, if you go back to your original one, you can bring in virtually different options. So I could, go back to my default position here. I can then bring in my private rent. I didn't really want to kind of do it live as such, but it's fairly reasonably quick to do this if you've got the units agreed and the different options you do. So then I'm quickly flicking from one product position to the other. Now I know that, Chris, that I've got a fairly reasonably small scheme, so although it's 50 units, I've only got one kind of column for different kind of products as such. So you can see here that I've turned off my rent to home buy and I've put on my private rent. So you can see the effect that is having on the MPV.
So you just put them in and you hide the ones, or you effectively sort of turn them off.
Yep.
And then you can pretty much turn them on and off until you get to something that works.
Exactly. So that's once you've got all the information in, then you can quickly model different scenarios. You could say, okay, we're going back to having 10 of those and 10 of those. I think the important aspect of it is you can try different things and try and keep the percentages for your affordable or increase the affordable position. So that's
something we were talking about, wasn't it? Like if the exposure is in the private sales market, then how can we increase the affordable to limit that exposure?
Yeah, and you can see, going back to my kind of spreadsheet here, what I've tried to say to, is that our 40% affordable here and 60% sale. Let's go to a 60% affordable and 40% sale. Well, you can see the impact that would have. Now, an organization might say, well, okay, we can swallow that. That's good because we're getting a 60% affordable and we're less exposed to the sale. But you can see the impact of what would happen if the sales values does drop away.
That's why we wanted the private sale.
Yeah, that's cross-subsidizing to make that kind of that work. But it is telling you, if you wanted to do that, this is the extra money that you require to do a little bit more. And again, just for effect, I did an affordable. Yeah. I did 100% affordable. So if you had wanting to change these to all 100% affordable, then this is what you require over the 35 years to make this work. We don't know yet. I haven't heard any government kind of backing for more grant going to be pushed into the in the social housing sector.
And that's the big question, isn't it, right now?
Yeah. There has been some talk about stamp duty being relaxed or stopped in the short term, which would obviously help house buyers to kind of encourage them to actually carry on with their purchase, or indeed do that.
Yeah, that's, let's be honest, that's people who have the money are just going to be a little bit nudged on, but people who don't have the money is not going, or are unemployed, it's not going to change their picture, is it? Stamp duty relaxing.
No, but see the impact on here. So the numbers here, I thought this was quite stark. So here, if we go down to a different product, rent to home buy, you can see our 40% position here obviously gives us a positive MPV. But then look what happens if we start increasing then our affordable. So we could, change this unit or this scheme to a 60% affordable, and then smaller rent to home buy, and then a smaller position on the sale, and we're still making a positive MPV. Obviously,
that 14% sale, And that's with is that, what is that, 10% or 5%? If we can push that right down to 14%.
Well, yeah, that was 14%. So I kind of did different scenarios of saying, okay, this is what would be our kind of break-even position on a scheme, on this scheme. So you can see here that we've got a 60% and only a 26% rent to home buy, and a less so on the sale position. So, and that was my break-even position. Obviously, there will be a slight impact of bringing back our sales values, but lesser so. And then I kind of looked at it as a kind of 8% affordable, and again lesser on the kind of on the sales value, and we can see that we slowly start going into a kind of a negative position.
Wow. Is there any way
Okay,
we can get the 5%, 10% NPVs into that so we can see what those mixes will do under a stress test?
you can do. Thank you very much, Chris.
I think that would be helpful.
I think because I didn't apply well, you can see that it would have a lesser effect on that value. As you can see here that we've got our original slightly probably different for 424,000 positive here, payback within 28 years, and then we are then dropping it away. Oh, sorry. Yeah, I've changed the kind of modeling here slightly. So, yeah, you're catching me on the fly now.
I'm sorry.
No, it's okay.
Our participants are very quiet this morning. I haven't had any questions. So please do ask me questions. You must have questions about this. Andrew loves live modeling. He's not. So throw us some curveballs.
Are there any questions out there? How's have you used Slido? Have you kind of asked a question on there?
Well, my Slido, I just asked about whether people think it's going to be a V-shaped recovery or a U-shaped recovery, and have nothing so far. But that was before the webinar started.
Okay. Right, so let's throw it open. Is there any questions? Hopefully.
Hello, we're getting people.
Right.
Marta Snapinska from Yorkshire Housing. We love them; they're great. Can you talk about an impact of completion delays and slower sales rates? And
absolutely, yeah, definitely. That's a good question, and again, alongside the modelling that you can do here is obviously the impact of having that on there. So if I go back to what I'll do, I'll just close this and I'll go back to my original scheme.
And Mark Hooper quickly wants to know, should we look to use the sensitivity tab?
Yes, I mean, by all means, do. That's kind of down the end here. I prefer to do an actual full appraisal and then save different options and seeing that. But yes, absolutely, sensitivity is there. The part about the sensitivity in ProVal is you kind of put in your questions in there and then recalculate the scenarios. It's not really looking at different products and the effect that would have. This is saying what is a change in value, what that impact on the appraisal, yeah, rather than saying, can I have different products and what's the impact of that? So, that's you can put in a number of questions on here, and these are generally saying, a 5%, a 10% increase in costs or sales values, and what would that affect the overall NPV? That's sensitivity. Or I would kind of quickly, and it is very quick, just duplicate this scheme and then have a different kind of scenario on there. So how I would do a model, a slight delay, we can be quite detailed in this. So if I go back to my units, And the first thing I can do is obviously timings. So the timings of this scheme, or these different units, we can then offset from the first handover. Clearly on this, I've just taken one date, but in reality, that's not going to happen, or I could put a phase. Remember, in your system, you might not have this position. These are questions that you can put in yourself, and then say, this is phase 1, this is phase 2, this is phase 3. And also then you can offset it from the first date that we have. So here we're saying these units, probably the affordable units, will kind of come before now, and then we can delay this for a period of months, and that will change the values you can see here. Even though it's an outright sale unit, it's still an in and out transaction, so you could see the impact of that's happening. So the first part is saying this is when these units are going to be delivered, and then we can say, okay, what is the timings of these units? So if we go to the sales section, we can then say, right, here is what we're selling, 100% of these, whatever value you've put in, there's the date that we're having. Now, it might take you a couple of months to get yourself organized, hopefully not, to actually start getting ready to sell these. And then here we can then sell X amount per month. Now, if you've got 10 units, it's going to take you, obviously, that's going to then delay it 1 per month for this individual unit. So it's on an individual basis, and you'll see that affecting the cash flow. So if you went to the development, when you go to the development cash flow, you'll see the timings of that spread impacting on the interest that you're getting for those units. So if I look at the the development cash flow, and I look at the kind of the sales here, and if I grab the bar, and if I kind of look at I can see the values start hitting that
Wow.
that position. Yeah.
Yeah. And is that, I hope this gives you a good answer, Marta. Okay. So it's 10:53. I really don't want these to go on too long. I really want to keep them short and sweet. If anyone has any questions, let me know now. But I think it's time to wrap up. What is it we're doing next week again, Andrew? Is it it's more of it's affordable, something to do with shared ownership, right?
No, we are going to do. I think my video camera is coming on. I think we are gonna do a round robin talk on different people about the impact of how they would see what would happen in the sector, or from their position, what they think would happen in the sector in the coming months, and indeed the next year, how that is impacting. So we're going to speak to a few consultants, different people from different organizations, to see what they think would happen or could happen, and we're going to pose some questions and get their view on it.
Okay, well, I'm looking forward to that, because I really do want a range of opinions, so that we can give people people can make an informed choice based on as much information that we can give them right now.
Yeah, and remember, if anyone wants kind of a demonstration or land val, pro val, to review things, then we're here to help, to remodel stuff, or to have a look at their appraisals and just give that critique view of it, audit them, support you in trying different things, and discuss that. We're more than happy to help you in this difficult times.
Absolutely. Okay, well, with that, like I said, get in touch with us afterwards and look out for the next one. And yeah, thank you very much, everyone, and
okay.
goodbye.